Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. I am here with the author of Your Fiscal Physical, 7 Keys to Becoming Financially Fit. Find that book on Amazon. You might know him better as the founder of Alchemy Wealth Management, Mr. Ryan Nelson. Ryan, how art thou today?
I am doing well. How are you doing?
I am staying alive, man, staying alive. We got some, we're knee deep in the nice weather here in Reno, and I'm loving it, man. I am super excited here. I'm even more excited for, this is our 30th episode that we put out here. Like, I feel like it went quick.
Absolutely.
And I look back and I'm like, holy smokes. Like, I was talking to my folks the other night and they're like, oh, like, we've been listening to your podcast. We're on like episode 17. And I was like, oh, wow, you guys are, and they're like, we're like 12 episodes behind. And I was like, whoa, that's right. We have 30 episodes.
Yeah, that's awesome.
That's pretty wild to think about, for sure.
It is.
But awesome, man. Well, let's dive into this next topic here. We're going to be talking today about time in the market versus timing the market, which sound very similar but are very different as far as your long-term investing goals or whatever your goals might be specifically. So I've mentioned before, Ryan, that one thing that as I've gotten older and forged new relationships or done new things is that the one thing that I can't get back is time.
Yeah.
You just really can't. I can something breaks or something, my raft pops up at Tahoe, for example. I can get a new raft, but I can't get that time back overall. And that's normally pretty bothersome to me. Sometimes I'll be sitting in bed, I'll be like, oh man, should I be sleeping as much as I do? Like, I'm just wasting this time. But today we're going to kind of talk about how time can actually work to your own benefit or a person's benefit when it comes to their financial portfolio. So I'll go ahead and turn it over to you, and let's dive into this, man.
Perfect. Let's do it. So I think again, I love this saying. It's about time in the market, not timing of the market. So yeah, what sort of that quote or saying means to me is it's about the amount of time you're investing, not so much, oh, did I get in at the, timing of the market kind of means like, did I get in at the top of the market, the bottom of the market?
Mm-hmm.
Did I have good timing? Typically if you hear people talking about, these different stocks or Jim Cramer, right, on Bad Money,
yeah.
buy, sell, right? That sort of makes you think that the timing of the market is important, right? Like, oh, now you need to be buy this really quick, or no, sell this one really quick, right? But I'd tell you what's probably that's probably a lot less important than you think. And what's a lot more important than that is just the amount of total duration or time you spend invested, right? So investing for 40 years is probably more impactful than investing for 2 years and being super lucky or super good at timing the individual investments, right? And so for today's episode, I used a resource from Charles Schwab, and I pulled these 4 different investors. This example has sort of been told time and time again by basically every financial institution's marketing team, but it's just such a good example. And so again, stealing Charles Schwab's example of this, we have 4 different investors. So there's Peter Perfect, Ashley Action, Rosie Rotten, and Larry Linger.
Great names. Names, first off. Yeah. Phenomenal. Yeah.
And so what this is they all invested for 20 years, and they all invested $2,000. They all, at the beginning of each year, they got $2,000.
Okay.
So imagine me giving you $2,000 and saying, hey, you can invest this whenever you want. You can invest it on January 1st, the day I give it to you, or you can time the market. You can try to put it in at the absolute best time, or put it in at the absolute worst time, or whatever, or not even invest at all, right? And so what this is the only thing we're talking about here is market timing. So they're all investing in the same thing, just the S&P 500. So sort of what a lot of people just call the stock market. So all 4 of these investors They're all investing for all 20 years. They're all investing the exact same amount of money, so $40,000, $2,000 a year for 20 years. They're investing in the same index. The only difference is when they invest their money. So Peter Perfect, every year he gets his $2,000 and he just has that crystal ball. He knows when the absolute lowest point of the market is going to be that year. So if it's March 11th, he just holds his $2,000, invests on March 11th.
Okay.
If the next year it's November 15th, he somehow has that crystal ball, waits the next year, invests that $2,000 that year on November 15th or whatever I said, right? And so somehow, this is completely unrealistic, of course, but in this hypothetical example, Peter Perfect has a crystal ball and he was able all 20 years to invest his $2,000 on the absolute most ideal day in that year. So pretty cool.
Yeah, that's awesome. Yeah.
Obviously impossible, but a super cool example. Now we have Ashley Action. Ashley Action, she gets her $2,000 at the beginning of every year on January 1st, and she just takes action. She just says, you know what? I don't know. I'm just going to invest this on January 1st every single year. I get my money January 1st. I'm investing it January 1st, and I'm not even going to play with trying to figure out when the good time is or the bad time is, right? So she just invests January 1st. Rosie Rotten, she's the absolute worst luck, right, of anybody, and somehow she manages every single year to invest it on the absolute worst day. So if the absolute highest day of the market happens to be whatever, June 12th, the money she happens to invest on that June 12th, right?
Sure.
So just the absolute worst luck every single year over that 20-year window, she invests her $2,000 on the absolute worst day. And then the one exception to what I've been talking about is Larry Linger. He just kind of lingers and he says, you know what? I think the best time to invest will be sometime in the future. Just never really gets around to it. And he puts his $2,000 in cash. So he never does invest.
Oh, okay. So he just holds on to that $2,000 every year.
Yep. So we have Peter Perfect. He's investing on the absolute best time every year. Ashley Action, she's just investing on January 1st every year. Rosie Rotten, absolute worst timing every year. And then Larry the Lingerer, he's just kind of hanging out. He actually never gets around to investing, just keeps everything in cash. So that's all four investors. We got $2,000, again, going in over 20 years for all of them. So let's kind of take a look at these. So just out of curiosity, so Larry Linger, he's got the same $40,000 invested. He is putting it in to a cash equivalent. It's like putting it in the bank. You get some small amount of interest rate. Sure. Take a stab at what you think his account balance might be at the end of 20 years.
So 40,000 over 20 years. I mean, he's going to get some growth on it. 20 years, maybe 50 grand is
good,
something like that.
Yeah, good guess. So, in this particular example, he made about 4 grand. So his account balance is just a hair under 44 grand. So never got around to investing. His balance grows to 44 grand. Now, Rosie Rotten, the absolute worst timer of the market possible, invested for all 20 years. How much more do you think she lost than Larry or made than Larry? So if you invest on the absolute worst time, I mean, again, unrealistic. Like
sure. Yeah.
Nobody can invest on the absolute worst day 20 years in a row, right?
Right.
But, we take a stab at it. What do you think?
Yeah, so I mean, if 40,000, even on the worst day, I mean, which would be crazy 20 times in a row, I'm guessing she probably doubled her money still. I'm guessing she's 80,000. Yeah.
Great guess. So I would venture to guess most of our listeners might think she was actually down. But she almost tripled her money.
Oh,
her
wow.
account balance at the end was a little over $112,000.
Holy cow!
Yeah. So I'll pause there for a second. And if we go back to our saying, right, it's time in the market, not timing of the market. So at the end of this sort of this event, as Rosie's reflecting back 20 years in the past, and she thinks about that investment she made 20 years ago. Yeah, she invested at the absolute worst time 20 years ago. But compared to today, that was still pretty good.
Sure,
the market's gone up a lot, right? And so when you think about it and you zoom out and you say, gosh, yeah, God, was that the best investment 20 years ago? Like, could you have picked a different day to invest? Sure. But 20 years later, it's like, well, I'm just glad I got it invested because I made a lot of money, right? So Larry the Lingerer, he has his money, it just kind of invested in cash. It grew to about 44 grand. Rosie, she's absolute worse luck. Her portfolio still grew to a little over 112 grand. Now let's take a look at Peter, Perfect Peter. So he happened to invest perfect timing every single year. What do you think his account might have grown to?
Wow, that's a great question, because I think about the, if he's did it perfectly, if Rosie did it the worst, Peter did it the best, she still tripled. I'm going to go probably he's 7 times more than he had originally.
Sure. So he put in 40 grand. So you're thinking like 280?
Yeah, like 280. Yeah.
Yeah. So his account balance was 138.
Oh,
138,000. So think about this. The difference between Rosie was 112,000. Peter was 138,000. So the worst timing in the world left her with, after 20 years, 112,000. The best timing in the world for him left him at 138,000. There is a difference there.
Yeah. Oh, yeah.
It's a lot smaller than most people would think.
Sure.
Right?
Oh, yeah. I thought it was going to be astronomically larger.
Right.
Yeah.
And so, again, if you reflect back, now we do the same practice for Peter. If we reflect back 20 years ago, it's like, well, the difference in the best day and the worst day 20 years ago, yeah, it feels like a big difference 20 years ago. But then we fast forward 20 years out, how the market's all grown, and you're like, yeah, really what was just important is I got invested 20 years ago. The absolute best day and worst day didn't have as big of an impact as you might think, right? And so a lot of times we get a little too caught up in the now, in the day-to-day changes of our portfolio, and we zoom out over 20 or even more. This example is 20 years, but it could be 30, 40, 50 years. And you start seeing how, wow, timing of the market is a lot less important than the time you spend in the market, right? And so Ashley, so we had, just to recap those names, so Larry the Linger, who never got invested, he had like 44 grand. Rosie, right, worst luck ever. She had about 112 grand. Perfect Peter, he had about 138 grand. And Ashley Action, who just invested every single year, right when she got the money, January 1st, she said I'm not even going to worry about timing the market. I'm just going to, when I get my money, I'm just going to invest it.
Right.
She had $127,000.
Okay.
So kind of right there in the middle of Perfect Peter and Rosie. And so it kind of an interesting, again, example of how little that timing actually mattered. Because these are so unrealistic too. Nobody's going to have the worst luck ever and nobody's going to have the best luck ever.
Sure.
Right? So these are the most extreme of examples we can even come up with. And it's using real historical data of the S&P 500 over a 20-year window ending in 2022. So 2002 to 2022. It's just using real data. And it's surprising, I think, to most people how little that timing actually mattered. So any questions around that? I got one other point to make, but any questions around that?
Yeah, the one thing that, well, first off, kind of just the shock and awe of like Perfect Peter, like being perfect, yes, but over the course of 20 years, like that's so interesting with him. The one thing that really stands out to me is Larry Linger. That's a huge difference between 44,000 and even the lowest of Rosie, 117,000. Right. I mean, that is that's money. As far as
you know what's I've never even really necessarily thought about this or walked through this with a client, but what I'm just kind of thinking here is too. What's interesting is, so if you think about this after 1 year, Rosie would have invested at the worst time during year 1. So in theory, at the end of year 1, that means wherever she invested at the highest point of year 1. So what that means is that January 1st of the next year, she was technically down. She had lost money in year 1. She had to have, right? Yep. Whereas Larry was still up. He still had his $2,000. And so if you were to compare these two after just 1 year, you'd say, well, Larry's beating Rosie. He has more money. Just leaving it in cash, he didn't lose any money. Rosie lost money. She had the worst timing, right? And even after year 2, she'd probably still be down. She would have invested now on put even more money down on the second worst,
right?
Or on the worst time of year 2. And so by default, she would have lost money on her year 2 investment. She might have now made some on her year 1 investment, but likely she would be down again. And so you look at this again, and Larry would say, well, I still have all my, 2 years of investment. I still have all my $4,000. Whereas Rosie, she's lost money 2 years in a row.
Sure.
And so you could see how these investors looking at a short time period could start justifying, no, the market's bad right now. It's not a good time to invest. Like, look at, my coworker, or look at my uncle, or look at my, whatever, and they're losing money. But you want to zoom out and look at this over a bigger time horizon. It's time in the market, not timing of the market. And you zoom out and you say, now you look at Rosie and you say, yeah, that investment she put in 20 years ago, she might have lost money on it 20 years ago. but now she's made probably a fortune on it 20 years later, right? And then the one she put in 19 years ago, she might have lost money on it in that year, but now 19 years later, she made a lot of money on it.
Yeah.
And in year 18, she would have lost money in it in year 18, but zooming out 18 years, she made a lot of money, right? And so, Rosie, the worst timer in the world, almost made 3 times as much as Larry, 2.5 times, whatever that is.
Yeah.
And literally had the worst timing.
That is so interesting to think about, man. And it makes me kind of think that I was like, man, I wish I would have gotten invested earlier. Like, always makes me think. I'm just like, oh man, I could have had another 10 years. Like,
I know it. But yes, and then so one other kind of point I want to use to drive this concept home. So if we think about a stock that's around today, let's say this stock costs $10, right? And we're considering buying this stock. So it costs $10. And we're saying, okay, should we buy this stock? I don't know. Okay, let me think about it. I'm thinking about this stock. And then it goes up to $11 next week. It goes up 10% next week. You're going to say, oh, why did I not invest in that? I should have invested in that, but I didn't. Now it's too high. It went up 10% in a week. I can't buy it now. I should have bought it at 10. I can't buy it at 11, right? And so if you kind of think about that, it went up 10% in 1 week from $10 to 11. And so now that's like the short-term fluctuations, right? But now if we take a look at some of these investments, like, over a 20, 30-year window, some of these investments go up 45, 50 times, right? Sure. Some a whole heck of a lot more than that. But so now if you think about this, if we zoom out a lot and we say, let's just for easy math say this stock went up 50x over a 30-year window. So now we look at it 30 years from now, it went from $10 to 50x. So now it's at $500. So now if you look at this company that was $500 and you say, and I was to say, hey, Aaron, you could have invested in this 30 years ago at $11,
right? Yeah.
You like whether you invested in it at $10 or $11, would it have been that big of a deal? Like when you zoom out and you look at it in the grand scheme of things, if there was a $500 company and you had the chance to invest in it at $10 or $11,
sure,
it's like the difference isn't. It's definitely different. Like, don't get me wrong, investing in it at $10 is still better.
Sure,
right?
Sure, right.
But at the end of the day, when we zoom out, it's like, okay, we want to have that longer term approach and say, okay, what is the market doing as a whole over a 30-year window? And if you invest in it at $11 and it even drops a little bit right after you invest in it, who cares? We're worried about time in the market,
right? Not
timing of the market. So maybe it would have been better off to buy it a week ago before it went up 10%. In the grand scheme of things, if you buy it for $11 and it goes up to 500 30 years later, you're in good shape.
Yeah, you're not really going to think about that like, oh, I lost that dollar or whatever it might be just over the, overall, you're still going to be pretty happy with that, I would say, as far as that investment goes. So.
Yep, exactly right.
That's awesome. And then that's a really good way to, both of those examples, there's probably, like I said, there's a reason normally when those examples are used by a lot of financial institutions and that because they're true and they're easy to understand, they're easy to break down, and that's kind of what we're trying to do here as well on this podcast is to break it down into digestible segments to where it's like, oh, I might not understand all this high-level stuff, but I can get the concept of it and be like, hey, cool. What is time in the market versus timing of the market overall? So
100%.
Awesome, man. Well, we'll go ahead and take a quick pause here, and we'll be back on the other side of this with some personal stuff. So hang tight.
And now, to put the personal in personal finance.
Welcome to the personal section of the Fiscal Physical podcast here. And if you caught our first part of this here, we talked about a common thing that gets shared with timing in the market versus timing of the market. And this is also a pretty famous question I'm going to ask you here, Ryan. I feel like everybody's probably been asked this or thought about this or seen it somewhere. So I'll go ahead and pose it to you. So if you could have dinner with 3 people, dead or alive, throughout the course of history, who would they be?
Yeah, I can't say I have ever been asked this question. I've definitely heard it. But I don't know that I have ever been asked it. But yeah, I think my initial thought is to go with some really smart, just revolutionary thinkers. So like the Da Vinci's, Galileo's, Isaac Newton's. But really, I think the more I think about it, there's probably such a big cultural and time gap that in IQ gap probably between them and me. That I'm just I'm like, I don't know that would be even a fun lunch. Wait, am I even gonna be able to understand anything or dinner? Am I gonna be able to understand anything they're saying or we're just on different levels? So, the reality is I'd probably want to be like, I'd probably want to do that dinner with like people who are either alive now or recently alive that like I could actually resonate like and enjoy our time together.
Yeah.
I think I'm on a huge Peter Attia kick right now. So I would love to. I'm a big fanboy of his, so I'd love to grab dinner with him. Neil deGrasse Tyson, I think, is just he's actually really funny and he's smart. He could just I think he titles himself a science communicator. So he's not necessarily doing a lot of the research. He's figuring out how to communicate it to layman's, which is awesome. So then I think you could actually stand to just learn an incredible amount from him. So I think he'd be fun to grab dinner with too. And then I think for number 3, I'll go with my fiance Katie, because what do they say? Happy wife, happy life.
Sure, so, absolutely. Now we're talking. Like, I'm going to need to change mine up a little bit too.
Exactly. So who are you thinking?
Yeah, and you made a good point as far as like, the I kind of like to have like a spectrum of people, but then again, I'm like, are we going to speak the same language even? Are we going to, have anything in common or whatever? But, for the purpose of this, because it's fun, I have 3 that I'd like to have dinner with Benjamin Franklin.
Yep.
I always found him super interesting with all his ideas, philosophies, and
air dries himself, right? Didn't
Absolutely.
we learn that on a previous episode?
Yes, he did. And the other one, this is really mixing it up, is Will Ferrell.
Okay.
The actor, comedian. Like, I just think he's so funny in general, and like it seems like he's genuinely just like that in general.
I thought about throwing a stand-up comedian or something on there just for fun.
Yeah, and the last one, this is Genghis Khan.
Okay.
Is the other one for the ruled the Mongols for a long, had this massive empire and just had really interesting like philosophies on, it was pretty much like join us or die kind of thing. And just the way he was able to unite like this whole group of people to, one, commit atrocities. We'll gloss over that, but just to expand this empire like all the way across like Asia and like everything, and just to kind of see like, hopefully I could get a translator there, but just figure out his thought process and how he was able to do that without technology. That's like the biggest piece of like how you were able to run this empire and how you were able to control this whole world pretty much without like being able to. It was a 7-day ride to the other side of the empire and stuff too.
Definitely interesting, right?
Yeah.
And he's probably your like great grandfather, right? Doesn't he
have a lot of kids? So I'm sure there's some bloodline that we all probably have a pretty good chance of getting there. So but anyway, I think that regardless, I think any of those options would be fun. I think just in general to sit down and one of the questions I always think, I was like, what are we eating? Are we having just some pizza, Baron?
Yeah, I would think we'd have to.
Absolutely. But cool, man. I appreciate you humoring me there, Ryan. And, I also appreciate, the listeners checking us out, sharing us, hitting us up about listening to the podcast, enjoying the episodes, what they've learned, what they, feedback, questions that are going to be sent in. So, please continue to have that coming our way, and look forward to bringing you more of these episodes. And I'll let you finish us out here, Ryan.
Thanks, Aaron. And as always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.